Module 6. Returns. Returns refer to the gains or profits earned from an investment. Returns are a critical aspect of investing, as they determine whether an investment is successful or not. The rate of return is the percentage gain or loss earned on an investment over a specific period of time, usually expressed as an annualized percentage. It is calculated by dividing the total amount of return by the initial investment and multiplying it by 100 to convert into a percentage. For example, if an investor buys a stock for $100 and sells it for $120 after 1 year, the capital gain is $20. The rate of return on the investment is calculated as 20 divided by 100, which is 0.2, or 20%. Investors often use rate of return as a measure of the performance of an investment, as it provides a standardized method of comparing the returns of different investments. In addition to the rate of return, investors may also consider the risk associated with an investment when evaluating its potential returns. Investments that carry higher risk, such as stocks or high-yield bonds, may offer the potential for higher returns but also carry a greater chance of loss. Understanding returns is important for investors to make informed decisions about where to allocate their funds, and to assess the performance of their investments over time. Risk-free rate of return. The risk-free rate of return is the theoretical rate of return of an investment with zero risk. In other words, it is the return that an investor can earn without taking on any risk, such as the risk of default or market fluctuations. In practice, no investment is entirely risk-free. However, some investments are considered relatively low risk, such as government bonds issued by stable governments or bank deposits insured by government deposit insurance programs. The risk-free rate is an essential concept in finance because it is used as a benchmark to evaluate the performance of other investments. For example, when evaluating the expected return of a stock or a portfolio of stocks, investors often compare it to the risk-free rate to determine whether the investment is worth the risk. The risk-free rate also plays a role in determining companies' capital costs. The cost of capital is the minimum rate of return a company must earn on its investments to satisfy its investors. The risk-free rate is used as the baseline rate of return that investors could earn on a completely risk-free investment, and the cost of capital is typically set as a premium above the risk-free rate to compensate investors for taking on additional risk. In summary, the risk-free rate of return is the theoretical rate that an investor can earn on a completely risk-free investment. It is an essential concept in finance that is used as a benchmark to evaluate other investments' performance and determine the cost of capital for companies. Bond. A bond is a type of financial instrument that represents a loan between an investor and an issuer, typically a corporation, government, or other organization. When an investor buys a bond, they are effectively lending money to the issuer for a specified period of time, in exchange for regular interest payments and the return of the principal amount at maturity. Bondholder. A bondholder is an individual or entity that owns a bond issued by a government or a corporation. When an entity issues a bond, they are essentially borrowing money from the bondholder and promising to pay it back at a later date with interest. Yield to maturity. Yield to maturity, which is often abbreviated as YTM, is the total return anticipated on a bond if it is held until it matures. It is also known as the redemption yield. YTM considers not only the interest payments the bondholder will receive but also the difference between the price paid for the bond and the face value of the bond at maturity, which is the amount the bond issuer has agreed to repay the bondholder. YTM is calculated by solving the bond's pricing equation for the interest rate that would make the present value of the bond's future cash flows, coupon payments and face value payment at maturity equal the bond's current market price. This interest rate is the YTM. The calculation of YTM is complex and may involve trial and error, as there is no simple formula to determine it. However, it can be calculated using financial software, spreadsheets, or specialized calculators. Yield to maturity is a helpful measure for comparing different bonds with different maturities, coupon rates, and prices. It indicates the return the bondholder will receive if they hold the bond until maturity. However, YTM assumes that all coupon payments are reinvested at the same rate as the bond's yield, which may be unrealistic. Also, YTM does not consider the possibility of default or changes in interest rates. Bond price. A bond price represents the current market value of a bond, and it is the amount that an investor would need to pay to purchase the bond in the secondary market. Bonds are debt securities issued by companies, municipalities, or governments. When investors purchase a bond, they are lending money to the bond issuer, who agrees to pay interest on the bond at a fixed rate and repay the principal amount when it reaches maturity. The price of a bond is determined by the supply and demand for the bond in the market, which is affected by many factors, including prevailing interest rates, the issuer's credit rating, the bond's maturity date, and any other provisions such as call or put options. When interest rates rise, the price of existing bonds decreases because the fixed interest rate on the bond becomes less attractive relative to new bonds, being issued with higher interest rates. Conversely, when interest rates fall, the price of existing bonds increases because the fixed interest rate on the bond becomes more attractive relative to new bonds, being issued with lower interest rates. Bond prices can also be affected by the creditworthiness of the issuer. Bonds issued by companies with poor credit ratings are considered riskier investments and, therefore, will typically have a higher yield to compensate for the added risk. This can result in lower bond prices as investors demand a higher yield to invest in such bonds. Overall, bond prices fluctuate in response to changes in the economic and financial environment and investor sentiment and expectations. Dividend payment. A dividend payment distributes a portion of a company's profits to its shareholders. When a company generates earnings or has accumulated profits, the board of directors can decide to distribute a portion of these earnings to shareholders in the form of dividends. Dividends are usually paid in cash but can also be paid in the form of additional shares of stock, also known as a stock dividend. The board of directors of a company determines the amount and frequency of dividend payments, although the shareholders must approve the amount. Dividends can be a source of income for shareholders and are often sought after by investors looking for stable investment returns. However, not all companies pay dividends. Some may reinvest their earnings into the company for growth and expansion or to pay down debt. When a company announces a dividend payment, it will typically specify the amount of the dividend per share, the record date, the date by which investors must own the stock in order to be eligible to receive the dividend, the ex-dividend date, the date on which the stock begins trading without the dividend, and the payment date, the date on which the dividend will be paid. Overall, dividend payments are an essential aspect of a company's financial management, as they help attract and retain investors and signal to the market that the company is financially healthy and profitable. Assume PepsiCo issues a dividend of 43 cents per share. An investor with 1,600 shares will receive a dividend payment of $688. This is because dividend payments are calculated simply by multiplying the dividend per share by the number of shares owned. In this case, the dividend per share is 43 cents, and the number of shares is 1,600. 43 cents times 1,600 equals $688.